we're going to talk about something extremely important: how to build an option portfolio from scratch. Because the problem is, on your Google or on YouTube or whatever it is, when you watch something around options, it's cool to know how to do a short strangle. It's cool to know what is the extrinsic value of an option. However, it can be quite challenging, and I had this challenge myself, how to actually start, how you can actually build an option portfolio, how do you maintain it, how do you practically do this. And that's why I wanted to share with you how I built my option portfolio, how do I maintain it, what are the things that I'm looking at on a daily basis. So hopefully if you're trying to do the same, if you're starting with options, you will know at least at the end of this video how to maintain, how to build your options portfolio practically. And I'm not going to talk about all the conventional strategies, like which strategies to use and everything. That will come in time. I'm first of all going to explain all the fundamentals, the rules that you really need to understand, how I think about when I trade options, how I think on a daily basis. So even before we talk about strategies, even before we talk about all the details, you understand what are we actually striving for. So the first thing that you need to understand when we talk about, building an option portfolio, selling options, all those things, is that it's all about margin. It's all about buying power. And what do I mean by this? Let's say that you want to sell, for example, an option on Uber. Like you sell an option that is around 40 days to expiration, something like this, that is around 25% out the money. It's going to cost you around $250, $300. That's the buying power that you need in your account to open that position. And the thing with selling options is that that $250 that you needed in your account when you open that trade on Uber, it will fluctuate. It will fluctuate with time as the trade goes in your favor or against you. Especially if it goes against you, you will need to put more money on the table. So for example, in the case of Uber, you could expect that if you open a trade and you needed $250 to open that trade and it goes against you, maybe you'll need to have $400 now in your account just to maintain that trade. That's how it works when you're selling options. It's all about margin. It's all about having enough cash in your account so you can maintain your positions when they go against you. Of course, I'm talking more about when it goes against you, because when it goes in your favor, do we really need to talk about it? When it goes in your favor, you're making money. So there's not really a problem there. But we need to understand that when it goes against you and you're selling options, your margin that is required, the amount of money that you need to have in your account to maintain your positions, will increase. The reason I'm saying all of this is that when you sell options and you want to build a portfolio, the first thing that you need to think about is that your total capital, let's say that you have 10 grand, you won't invest the 10 grand. I would recommend you only invest 30% max of that capital. So that means $3,000 out of those $10,000 maximum at any given time. So $3,000 out of $10,000, that's 30% of your capital that you will invest max at any given time. Why? Well, for the exact reason that I've said before. So if the trades that you have taken with those $3,000 happen to go against you, and trust me, they will always go against you. There'll always be misbehaving children. Trust me, like there's so many trades that I wish I didn't take. But anyway, when those trades go against you, the margin required will go from, for example, $3,000 to $4,500, for example. So you need to have cash in your account so as to be able to sustain the trades that go against you, that require more money to maintain the trades. That's how the game works when you're selling options. It's all about margin, and it's all about making sure that you have enough cash in your account so as to sustain the trades that go against you. So let's say that we take back our $10,000 account, for example. Let's say that you want to invest 30% of it, as we mentioned. So you're going to invest $3,000 out of those $10,000 right now. How would you proceed? Well, even before talking about which stocks and everything, it's important to understand that you're not going to dump 30% of your whole account into one trade, into one single stock. That would be, let's say, unwise. You are going to spread those 30% between different positions. So in the end, those 30%, they are actually separated, they're actually spread over different stocks, and that makes your portfolio. The way I do it myself, the way I'm going to allocate, for example, those 30% to different stocks, I'm going to stick to around 2% of my account per position at when I open the trade. So if we take back our Uber example, where you remember that I said that to, for example, sell an option on Uber, you would need $250. That $250 should represent 2% of your account so as to open the trade, or at least that's the rule that I apply to myself. So if you don't know how to calculate how much money you would need, for example, to allocate 2% per position, take for example the trade that I said on Uber, $250 to open that trade. That should represent 2% of your capital. So if you take 250 divided by 2%, you see that you will need $12,500. So those $250, they only represent 2% of your buying power. That's how I'm going to invest myself. I'm going to usually stick to around 2%, and I'm going to allocate that after that to different stocks. And the positions that I will open will always be below 2% of my total buying power. And in aggregate, all those different positions will represent around 30%. For me, it's more 25%. I actually prefer 25% over 30%, but just personal preference. But I already hear like the different comments. Wait, that means that you actually need a lot of capital if you want to sell options. For example, let's say that you want to open a trade on, I don't know, on Apple or whatever high price stock that you can imagine. And you see that the buying power required to open usually a trade on Uber is going to be several thousands. So if we think like this, let's imagine that you need $2,000 to open a trade on Apple. That $2,000 should represent 2%. So that means that you need to have 100 grand to trade Apple. If you follow the way I do it, then yes. However, nothing prevents you to increase a bit the risk. And what I mean by this is that instead of sticking to 2% per position, now maybe you can do 5% per position. So if we take back the Apple example, 2,000 divided by 5% means $40,000. So now you can have an account of $40,000. If you allocate 5%, then you can trade Apple if we go that way by the 5% rule. However, the more allocation you do per position, the riskier it is for you, because if that trade goes wrong, and I don't know, if Apple falls by 50%, then it's going to hurt a lot more than if you had only allocated 2% for that position, which makes sense. But I understand that selling options is quite capital intensive, unfortunately, and there's no other way to put it. Yes, you can increase the risk, but personally, I would never go above, for example, 3%, 4% per position. Above 3-4%, I think it's a question of time until you're getting into some very big trouble. And honestly, I get it. When I started trading options myself, I was starting to work actually in the active world, in the professional world, so I didn't have much capital, I didn't have much savings. I mean, it was a pain to sell options, and honestly, like, it was really, really hard because I had to build up my capital, so after that be able to trade in a safe way following that 2% rule. But I think it's worth it. Being safe and aiming for the long term, even if you don't make a lot of money at first trading options because you can't afford to risk a lot, I think it's still worth it to, just go safe and aim for the long term rather than trying to make some bucks quickly. Go for, let's say, 7-8% per position and then you blow up the next year. So just to recap, before we go into maybe a more complicated aspect of building a portfolio, I just want to do a small recap so we're all on the same page. When you sell options, it's all about margin. It's all about having enough cash in your account so you can maintain positions when they go against you. Ideally, don't invest more than 25-30% of your total capital so you make sure you can maintain the positions that you have open. So enough for the theory. Now let's go into a bit more practice so I can show you maybe the first steps that you could take yourself if you're willing to build an options portfolio from scratch. So let's imagine that you have, 10-20 grand to invest and you're going to follow that 25% rule. So if you have 10 grand, that would mean around $2,500 invested maximum. You just do the math. You take your account number, you multiply it by 25% or 30%, and that's how much money you're going to invest maximum. Now, the thing that I would really, really highly recommend you, if you don't have a big capital, don't try to trade Apple, don't try to trade Nvidia or Amazon. Go for cheap stocks. The reason you need to go for cheap stocks is that you won't need as much money to open a trade on, for example, Uber than what you need on Nvidia or Apple or Amazon. When I started trading options, I quickly realized that my biggest problem is that when I wanted to open a trade, it was costing me $2,000 just to open the trade, and $2,000 was my overall account. So there was no way I could open a position for $2,000 when it's my whole account. That's why I started going for cheaper stocks. I started building myself a watch list of cheap stocks So actually I could go in there regularly and find cheap trades to make. I just didn't have the capital to afford more expensive trades. So to show you which type of stocks I have in this cheap watch list, I have, for example, AT&T, Foot Locker, BP, Twitter, Cisco, Intel, Pfizer, Uber. I mean, you name it, you know, all the stocks that are around $20, $30, $40. I love this type of stocks because especially for beginners, especially for people that don't have much capital, you don't need as much money to place the trade than if you were willing to place a trade, I don't know, on Amazon or Apple or you name it. So let's say that, you know, you have founded your account, now you want to place a trade. You want to start actually building your portfolio. How would you do it? Well, let's say, for example, that we pick Uber. I was talking about Uber before, so let's take it. You're going to go in the option chain of your broker. I personally use Tastyworks. I think they're a really, really good broker, especially for options. You're going to go in there. I'm not going to go into too much details, which expiration I'm choosing and stuff like this. I've been explaining it in a lot of videos. To make it quick, if you don't want to listen to the other videos, I usually go for 30 days to expiration, somewhere around this. So I'm going to go, for example, for the May 20th expiration. Now, once you click on it, you can see that you have all the different strikes that open. You see that on the one side, on the left side, you have calls, and then on the right side you have puts. So let's say that based on the stock chart, you can see that the stock is currently at $32 per share, and it came down actually quite a lot. In April 2021, it was around $60 per share. So you see that it came down actually by quite a lot. So the way I would trade myself, I tend to sell mostly puts. I have a tendency to sell puts. It's crazy, honestly. I see everything going up. Like in my head, everything is always going straight to the moon. No, just kidding. The reason I'm mostly selling puts is that not only the stock market overall as a whole tends to grind up on the long term. That's why I tend to be a bit biased on the put side. I tend to sell more puts than what I sell calls. But also puts are more expensive than calls in general. Puts tend to be more expensive than calls, and there are several reasons to it. A lot of people have long stock portfolios and they're going to buy puts so as to hedge their portfolio in case of a market crash, whatever happens. But because of that, because a ton of people are buying puts, put prices get more expensive. And when you sell them, it means that you make more money. That's another reason of why I tend to sell more puts than what I sell calls. But anyway, let's say that on Uber right now, I want to sell a put. Personally, I'm actually going to sell a put right now on this one. So what I'm going to do is that I'm going to go in the option chain and I'm going to focus on the right part because this is where puts are. Usually, I'm always going to go for the same strikes in terms of how far they are from the current stock price. I'm usually going to stick to what we call the 25 delta. So if you don't know what I just said, don't worry, it's very easy to understand. The delta is how much money an option gains or loses for every dollar change in the stock. But that's also used in a very different way. Usually we use it as a way to know how far is the strike that we're talking about compared to the current stock price. For example, the 50 delta is where the stock price is. That's the column that you can see on the right within that reddish rectangle. You see that you have the delta and you have plenty of numbers. So what that means is that, for example, here you have the 33 delta for the 30 strike, you have the 20 delta for the 27.5 strike. Usually when you trade options, that's how you refer to the strike so as to see which type of risk you're taking. And to give you a very quick way of knowing how likely it is that you're actually going to be right or wrong, the delta can be roughly associated to the probability of expiring in the money. Well, let's say that you sell the strike that is around the 25 delta. Well, that strike has roughly 25% chance of expiring in the money. And so 75% chance of expiring at the money. So that's usually what I'm going to stick to. You know, sometimes I can go closer, sometimes I can go a bit further away out the money, but usually they will go around the 25 delta. So in our case, I would be basically between the 27.5 and 30 strike. So for example, let's say that I'm going to go for the 20 delta. I'm going to sell the 27.5 strike. I'm going to collect a credit of around 85 cents, which makes $85 because one option controls 100 shares. So 85 cents times 100 equals $85. That's how much I'm going to collect as a credit when I'm going to sell that put option. And remember that I talked about the margin before, how much money you needed to open the trade, etc., etc. Well, you can find here, you see that there is something called BPF, so buying power effect, $276. So what that means is that I need $276 to open the trade. After that, when the trade will go a bit in my favor, that buying power will reduce probably to $200 or even less. And when the trade goes against me, that buying power will increase. So it will go probably to $300, $400, something like this. So that means that you need to have a certain amount of free cash in your account so you can sustain the position if it goes against you. That's why I always say that you shouldn't invest more than 40%, 50% of your account, because otherwise you might run into a very bad situation. What might happen is that the trades are going to go against you, but you won't have enough free cash in your account so as to sustain, so as to maintain the position. So what is going to happen? If that happens, you're going to run into a margin call. That's something that you'd never want to run into. That means that the broker will force you to close some positions for a loss because you don't have enough money to maintain the position and they don't want to lose money. So they will force you to close a position for a loss. And trust me, it never happened to me, but it hurts. Like, it really does hurt. So let's say that you want to risk, for example, 3% of your capital per position. Then you take 276 and you divide it by 3% to know how much money you need to have in your account so you can open that trade respecting that 3% rule, for example. As I said, I stick more to 2%, but I would understand if you want to go a bit higher for 3%, 4%, because maybe you have a smaller capital. And I'm actually going to put my money where my mouth is. I'm going to actually take that trade. So let me just review that trade and send. You heard that noise, it means my trade got filled, so I received a credit of around 85 cents and I opened that trade. It cost me, in terms of buying power, $276. Well, now that you have taken that trade, the goal is to take different trades like this one so you can build up your portfolio up to that, for example, 25% buying power used overall in your account. That's how you're going to build a portfolio from scratch. You're going to take those different trades that represent a tiny portion of your capital, but together they will make that option portfolio. And after that, you will manage the different trades individually, of course, but that's how you build it. You're going to try to build it to a certain percentage of your buying power used. Now, one question that I want to answer that some of you probably have: should you only have long trades, or should you have long trades and short trades? Well, here's my take on it. It can be very, very hard to only be either short or just long. In a market like 2021, I would have told you, sure, only go long. The market is only going up anyway. Sure, only go for long trades. However, just the beginning of 2022 shows us that having some short trades might actually be beneficial. Now I have more short trades along my long trades, so my portfolio will make money wherever the market goes. I have some positions that will go in green, some positions that will go in red, but I'll always be making money because I have some long trades and some short trades. But of course, we don't have the benefit of hindsight, meaning that I don't know if in 3 months the market will not just shoot up, and only having long trades would be more profitable than having both. You don't know what's going to happen in advance. But personally, I like to always have some short trades in my portfolio, so if the market goes down, I at least make some money on those positions. But for example, what happened for the first part of 2021 is that yes, I was making money, but I had some short trades that went into losses, and it took me 6 months to recoup those losses because the market went up so much. And for the later part of 2021, I went for only long trade almost, and I made a lot more money, but because the market was only going up. When the market started going down in 2022, now I started selling more short trades. I started taking some more short positions so as to try to make money off of there. So you never know what's going to happen. We don't have the benefit of hindsight. That's why maybe having positions that are long and short might be beneficial, or at least it is for me, so you can benefit from both situations. Okay, I'll stop there because I know that that's a lot of information and you're probably overwhelmed, so I'll just stop there. If you think this is necessary to do a part 2, I'm happy to do one. If you have any question or any comment, please don't hesitate to put it below. I'm always curious to know what you think, if you do the same, if you do different, or just if you have any questions to ask. Please make good and informed decisions. I'll see you in the next video, and in the meantime, I wish you all the best.